this I think is one of the most pernicious problems with fiat money. Is something I think about a lot. Is they use this form of opaque theft, as you're describing, often called the shadow tax of inflation, right? That people don't know what's happening, right? The prices are going up. The government's blaming the supply chains, or they're blaming the greedy capitalists. And so there's this plausible deniability that the government has that they exploit. But then that is the weird part, is those proceeds that are stolen are used to fund, Keynesian economic pseudoscientific paradigms. The fake news of Joe Biden on the Super Bowl saying, "Oh, the ice cream price is going up, and I'm gonna not let the ice cream producers do that again." It's like this. The theft itself is then used to fund the ideologies that justify the theft, and so we get trapped in this like weird cycle. How do you think about that?
So it is a really big self-reinforcing network effect,
Yeah.
which is why I think it still lasts quite a bit longer than maybe we'd hope for. But at the end of the day, it's still funded by bond markets. Propaganda starts to kind of diminish when the bond market is obviously failing.
This is happening now.
Yeah, and different parts of the world at different speeds. But people eventually lose faith in the thing that they were maybe previously had faith in, because when things seem reasonably stable, you're more likely to believe things that are not true, that are kind of shown to you.
Yeah.
Whereas when things around you are just not working well, you're more likely to question things.
Yeah.
I mean, that happened, the whole like Cold War. If people got a taste of, if they were in one of the less free parts of the world and they got a taste of what the outside world looks like, it's well, wait a second, I don't seem like I'm on the winning side right now.
Yeah, for sure.
Whereas if you didn't even know that outside world existed, how would you even know?
Nothing to compare it against.
Yeah, and so I think that as this plays out, that kind of self-referential microphone just gets weaker and weaker over time. And like right now, gold is kind of reasserting itself in the global central bank system. They're saying, look, I don't fully trust the dollar. Some of these countries are stacking gold. I think some of the smarter ones, usually smaller ones, some of the smarter ones are also stacking Bitcoin. So around the margins, they can talk all they want about how the treasury market is safe, but they're increasingly, institutional investors that are like, this fiscal train's not going to stop anytime soon. And there are central bankers saying this is not going to stop anytime soon. So that trust can still erode over time, and it just takes a while.
That's a great point. I remember in college learning about the risk-free rate, and I thought my head was going to explode. I'm like, what? That's not risk rate. That doesn't make any sense. But it's just this whole idea that the government, U.S. government in this case, can issue a treasury bond, and then they're the counterparty that never defaults because they can always issue the currency.
They can always print.
But that presumption or that axiom or whatever it is now not, it's crumbling, right? Or it's starting to crumble.
It's crumbling, and also as that ledger gets more top heavy.
Yeah.
So as we kind of build up, debt on the sovereign level, for example, people are more aware of the fact that sure, it's technically risk free unless they kind of choose to default on sort of technical grounds. But you're not free of debasement risk.
Yeah.
So if the risk-free rate, let's say that the Treasury yields 4%, and the money supply is growing at 7%, your actual rate is like -3% per year.
Yeah.
You're getting bled out.
Yeah.
And that's kind of like paying really high property taxes.
That is a default, right? I mean, it's not a total default. It's like a partial incremental default.
Yeah, and then in history, this tends to happen kind of in bunches. So, for example, during the 1940s. They didn't default on their treasury bonds, but they printed so many dollars, and they defaulted on all their prior like gold obligations. That happened in the 30s, and then it happened again in the 70s. Those are types of defaults. And basically, we see this around the world, that when you get this lever, there's going to be a default. It's rarely going to be a nominal default in your own printable currency units, but instead it's a default in purchasing power. And particularly, it's a default compared to the most scarce things. Yeah. So even if they manage to keep inflation somewhat on the rails for things like food and electronics and other kind of things that we're way more productive at making, it's still a major default on anything of like truly scarce value that people want. High energy stuff, good properties, gold, Bitcoin, these types of things. The ability to fly comfortably, the best healthcare. Yeah. That is a default on those types of things.
Yes. Okay. That makes sense. Last question on this. I saw someone tweeted this today and I missed this announcement, that someone announced at this conference that funding Lightning channels was generating like 9% yield.
Block did that, yes.
Block did. Okay. And it was, again, risk-free rate maybe is a dangerous word, but this is close to risk-free rate on Bitcoin, perhaps. I want to ask your opinion on it. This is obviously something Nick Bhatia predicted 3 or 4 years ago. What's the legitimacy of that as like being the future risk-free, air quotes, rate for Bitcoin? How do you think about that?
So I wouldn't call it risk-free, but it is interesting because it's self-custodial yield or self-custodial ROI, which is interesting.
Yeah.
The reason it's not fully risk-free is because in a Lightning channel, it's basically a hot wallet, right? So you're making a security trade-off. Instead of having like deep multi-sig cold storage, you're bringing some of those coins up to the surface. And, you know, this has been a fairly stably operating system, so it's a fairly low risk. But there's still some risk. And it's just that they're not relying on a counterparty. So it's a new way to generate ROI. And then there's also a skill issue. Either they have to do it themselves or other entities can, in some cases, find a service to do it for them, like a Lightning service provider that is able to do this. But basically, that's, you know, putting assets to work to help move things around.
Yeah.
And so I think it's fully legitimate. I just wouldn't fully call it risk-free.
Yeah.
But I do think that there is kind of this new, basically a yield curve forming, which is, you know, in a Bitcoin world, there's some money to be made from enabling liquidity. And that you know, makes some degree of kind of technical, you know, risk trade-off. And then there's still a role for lending. It's just not the type of lending we're associated with. There's still, for example, I think collateralized lending. If someone has a house and they want to borrow 10% of its value for liquidity purposes, you can make a contract with someone that says, look, I'll loan you 10% of your house worth of Bitcoin, but if you somehow default on this, I get your house.
Yeah.
And you know, and so that type of lending can still exist. It's just a much smaller part of the economy than what we're used to in a fiat system, because in the fiat system, there's really 2 types of debt. One is like high ROI debt. Like a small business wants to expand. They take a 2-year bank loan. They put it to really good purpose, hopefully, and then they build something where you want to go to
credit.
you want to get a engineering degree. You know, you take out some debt and go through the system. Then there's like the type of debt that you only have because you're arbitraging, you're shorting fiat currency. So that includes government debt, basically. That includes there are companies that have been profitable for like every year straight for like a century, like, you know, Coca-Cola and Procter & Gamble, for example. And they have like $40 billion in debt each, and yet they're highly profitable. It's like, why do they have that debt? And it's like, well, because they could issue it at 2% and basically short a 7% growing currency for 30 years at 2%. So they did. And then they bought better things with it, like their own stock in many cases. And so that type of like debt that only exists because you can doesn't make sense on a Bitcoin standard. But, you know, high impact collateralized lending still makes sense. And then using Bitcoin for, you know, liquidity purposes, like generating with your own Lightning node. That makes sense.
Thanks for watching. If you enjoyed this episode, click here to find more just like it, and here to find our most recent episode. Also, make sure to like this video to help shine light on the corruption of money. And be sure to subscribe to this channel to stay connected.